But let's welcome then our market master, our market guest. We have Gautam Chhaochharia, Head of Global Markets at UBS, who joins us on the show. Hi, Gautam. Where are you joining us from? India or?
Still on Diwali break already. So, but again, you guys wanted me to be there. So, yeah.
Good.
Happy Diwali to you and all the viewers.
Happy Diwali to you, to your entire family as well. I briefly bumped into you a couple of weeks or so ago. So you're clearly in festive mode, Gautam. But what do you feel about the markets? You know, everyone's talking about this last 1 year underperformance, that the Indian markets didn't party. You think our time has come?
I think three points. Technically, the markets are still stuck in range bound. And I say that simply because there is enough local liquidity in terms of mutual fund flows to support the market on the way down. But there's also a large pipeline of capital raising, which will potentially cap any meaningful upside. So that's a technical part. But beyond that, tactically, again, if we see progress towards a trade deal, that will provide some legs. Fundamentally, the valuations in absolute terms, earnings outlook, if you combine that, that's still not appealing risk reward for the broader market yet, unless we see a big breakout in fundamentals. Again, there's been a lot of hopes around consumption and GST cuts. But we have to see beyond that, because the consumption stimulus or GST cuts can provide near-term support to economy, but it needs to be followed up through a broader capex cycle if we need a sustained economic cycle. So that part is still missing or still something to see.
On the EPS front, Gautam, what is your expectation for the remainder of this year and more importantly the next year? Because most on the street are pricing in 15-16% plus EPS growth in FY27. Do you think that's possible?
So look, I think the estimates for the street is not what investors tell us. In investors' mind, I don't think they're looking at 15-16% growth for Nifty EPS in FY27. They are more like high single digits to low double digits. That's where the market expectations are. And that's something definitely should be feasible. In fact, 15-16% is now not out of range simply because of the low base which will be there. And there will be some impact from GST cuts, policy easing, etc. for sure.
And this particular year, I mean, do you think the second quarter is practically a washout quarter, so to say? The next couple of quarters where a lot of hopes are pinned because of the GST cut, and you're saying that there is a short-term impetus likely. So do you think a bump up in the third and the fourth quarter?
Again, some marginal bump up, yes. Meaningful bump up, too early to say. Like we have seen even the GST, the big debate out in terms of what the impact is. And our auto analyst had a very interesting note out that while if you look at just the Navratra period, the headline Y&Y growth for two-wheelers, four-wheelers is 20% plus. But if you start from, say, the Onam period, which is the right way to look at from adjusting for seasonality, etc., the growth is lower single digits. So we're still not seeing the big impact yet, which gives us confidence that we'll have a sustained upcycle. So it's early days, but again, a marginal uptick in 3Q, 4Q for sure. Whether it's going to be meaningful or not, it's too early and fingers crossed.
So auto sales, you're saying it's a subdued uptick, just about 9% if you look at the cumulative festive season sales. Are you getting a similar data point from the other consumption indicators?
Again, it's a mixed bag. Look, the FMCG, the consumer staples, etc. There, the inventory part has been much more, or is making the scene much more noisy around the GST cut. So very early days, and again, looks like the uptick is not as strong as initially believed. But again, the four-wheelers, two-wheelers, we saw some uptick in the festive days specifically, but for an entire season, it still looks below expectations.
Got that. So we are overestimating the benefit on consumption on account of the GST sales. Is that yet to reflect in the stock prices? Would you say that?
So I won't say overestimate as yet. In the last couple of weeks, the markets got ahead because the GST cuts are permanent. So the impact is not just for the 15 days. It will remain as we go along. So that's a great thing in terms of the cycle. In terms of stock prices and markets, again, markets, as I said, is stuck in a range-bound level. Hasn't moved up, hasn't moved down materially. So it's not really pricing in any major uptick from GST impact. No, it's not pricing it yet.
So since, Gautam, Indian markets have been range-bound and you're the head of global markets, if you just zoom out, India's range-bound performance has underperformed, say, Taiwanese markets or Korean markets, where you have a lot more AI plays, and they've been the big beneficiary of this tech upcycle. Is there anything on the horizon which warrants a change, that perhaps investors will start looking at India, maybe because the other emerging markets have run up too much, the valuation, the gap between the two has changed, or the fact that India's earnings, maybe on account of a low base, is changing? I mean, is there anything which makes you believe that India's underperformance vis-a-vis emerging markets could reverse?
Look, our EM strategist still remains underweight on India from an EM portfolio context. Having said that, tactically, yes, we have seen a big divergence, or as you said, India underperformance this year. And if you see some progress on trade deal and some impact of GST, etc., locally, then yes, underperformance can reverse fairly quickly. Because positioning-wise, from a global investor positioning, it is light from an India perspective. Both positioning in terms of actual weightage in their portfolios, as also their sentiment and outlook. From our discussion with global investors, it still looks like they're not in a hurry to take up an India weight to any meaningful overweight in a hurry. So that positioning gives us comfort that if things fall in place, this underperformance can reverse fairly quickly. But is it going to happen in the next 15 days, 1 month, 3 months? That's the tough part to say. Over the next 6 to 12 months, possibly.
What do you think has to happen for this to turn? Apart from, earnings, obviously you will see some green shoots out there. It doesn't happen immediately, like you said. But there could be something else that may happen in the globe that may not, make the investors of that country or money which is going to those countries be favorable and perhaps be a tactical shift towards India. What could the scenarios play out as?
There's kind of maybe a kind of a circuit breaker around what's been happening around North Asia, China, between US and China, as you've been reading the news. Again, what our reading is, talking to investors, markets, I think everyone expects this to be short-lived. And we have seen markets being largely resilient around that. So I won't go on a defensive approach saying that, okay, things are not good between US, China, and therefore India will benefit. I would look at more if there's a real good India-US trade deal, which gets India's tariffs back to a competitive or even very competitive level versus its trading competitors. That will be a big catalyst for Indian markets, for sure.
So how are you positioning yourself, Gautam? I recall, there was a bit of a move between industrials as well as consumption. At current reckoning, the GST 2.0 is here. We know what the spends are. I think private spend still needs to pick up. Private capex could be the big trigger, I think, the big monetable for the next 12 to around 18 months. How would you position, between capital goods, industrials, and consumption on the other hand?
Thematically, we still overweight consumption, but again, it has to be pick and choose rather than a broad consumption pick. Like one of the themes we are clearly picking up in consumption across the board, which includes staples, discretionary, etc., is premiumization. Like autos, our analyst thinks the street is possibly overestimating in terms of the near-term growth. But within that, the premiumization place will possibly even surprise positively. So premiumization is one big theme. The second big theme around consumption is the consumption tech or internet or food delivery and quick commerce. There we still expect market's estimates to be met or even beaten. So that's another space where we are very, very positive. Industrials, we still remain broadly positive on defense, but again, selectively. So the stock level is much more selective. But again, at a macro level, it's more consumption over industrials. The other two I'll mention where expectations are fairly low and positioning light is IT services. Again, there's a debate about the longer term, but near term, the positioning, especially amongst global investors, is one of the lightest we have seen. And as we've seen in the early results for IT, the expectations are so low that companies are actually meeting or even beating, especially the mid-cap ones. So the mid-cap IT space and similarly financials, there are pockets which can deliver given the muted expectations, not in absolute terms, but given the muted expectations.
So in the large cap consumer names, what would be the ones that would, stand the test of this premiumization best and perhaps be investable right now?
So again, the autos, there are two-wheeler and four-wheeler names which are the obvious beneficiaries, both premiumization as well as EV. So that they are our top picks in autos and broader consumption space, or consumer-linked space. Within consumers, we would prefer the quick commerce delivery guys, and then specific companies which are playing up. Again, I can't name individual stocks, but specific companies geared to the premiumization theme, which is well known, the larger consumer FMCG companies.
So, which would be, something in the beauty and personal care space, a marketplace out there as well. Then there is, a recent entrant, which is in home services, which is pretty similar. The TAM, they say, is pretty similar to that of all the quick commerce players. Would you look at any of them?
Look, broader marketplace slash the internet consumer tech space, we remain positive. The home improvement, the new entrant which you're talking about, we don't have coverage on that, so I can't comment on that. But the broader home improvement space, we remain constructive.
Okay. Can you buy it at this juncture, these consumer tech platforms? They're great stories, but it's great if you've already entered in and you got in at a lower price. But at this price, how comfortable are you?
We're very comfortable. Again,
even to buy at this juncture?
Absolutely, because our analysts have done deep dive work on the TAM. And that one observation I have is that I have seen the TAM, even by the bullish analyst, expand over the last 1 year. The TAM estimates.
Gautam, thank you very much for joining us from your holiday. Wish you, your family, the entire team at UBS season's greetings and look forward to chatting with you next time. Do come down to our studio.
Will do. Thank you.
Thank you.
Same to you all. Thanks.
Happy Diwali once again. Let's get